Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update for Tuesday, March 3rd, 2020. I wanted to get a video out there because we had a potential market moving event here. With Fed just came in for the first time since, gosh, I don't know when, and came out with an emergency rate cut, 50 basis point rate cut. I can't remember last time that happened, is it good or bad for the market? I'm going to give you my initial gut feel. It's bad. I think bad things are going to happen after this. That's just my gut feel. And we're going to go over the technicals. I'm not going to react to gut feel. I'm going to show you levels to watch, both on the upside and downside. But my take on this is this. I'll just kind of give you my thoughts real quick. We had, of course, the White House recently downplaying the coronavirus, and personally, I think it's a little overhyped as far as the impact on the stock market and the economy, but that's just my opinion. Maybe I'll be proven wrong. Now, not that I'm on the same page with everything the White House is saying. However, so then you have the Federal Reserve coming in with a 50 basis point surprise rate cut, intermediate rate cut, which to me reeks of desperation. Last week I talked about the potential, what's the, are there any impacts, any mutual funds, or I should say, I'm sorry, hedge funds, any banks, any financial institutions that may have blown up or we'll soon hear about due to the recent drop. We had such a sharp drop, and sometimes that happens. I think it was Warren Buffett who said, when the tide finally goes out, you'll see who was swimming naked. And so what happens in a bull market, what that means, everything's going up, up, up. Everybody's buying on leverage. They're buying the same things long. Everything's hunky-dory till it's not, till you get a big pullback like this, and then it kind of reveals who was over leveraged, who wasn't, didn't have the proper risk mitigation protocols in place and all that. So we'll see. I don't know, and this could also rocket this market to new highs. So again, this is not a usual circumstance. So let's look at the charts, and that'll have to be our guide, because again, I just shared with you some of my thoughts, right or wrong, what may happen. Like I said, on face value, you have to take a 50 basis point rate cut as a plus, but you also have the Fed at near zero, and they didn't have a lot of bullets. I can say this: I agree with the fact to do 50. If you're going to do a surprise rate cut, you don't do 25. That's not going to do anything. It's not going to move the needle at all. You got to come in big and hope that it has the effect that you wanted. And so far, it did a nice pop, but really all it did is reverse the market was down. So here we are. Here's where I'm going with this. Okay, we're only up right now 1/3 or 1/4% in SPY, and we're still basically what the initial surge did. Here, let me show it to you on a 1-minute chart. Here was the pop. There is the 50 basis point rate cut. You wonder why the market instantly went up, in the 1-minute candle bar, 2.25%, rallying about 2.5. That's not humans. That's mostly the algorithmic trading programs, high frequency trading. They fire off orders in milliseconds. They pick up the headlines. They parse through the data quicker than you and I can, and they can enter an order a whole lot faster than you and I can grab our mouse and keyboard and type, buy or sell X number of shares of SPY. So, but what did they do? They faded it. So number one, like I said, I'm viewing this with a bit of skepticism here. I'm viewing it as a desperation call. And the most important thing, what is everybody else going to think of it? Number one is how much longer are low rates going to have an impact? How much longer are these rate cuts going to have an impact? We're near zero now. We've been there for a long time. I've said this for a long time. Who hasn't refinanced their mortgage, or what business hasn't taken out, refinanced their debt over the last 10 years? So you get to that point where you're pushing on a string with these rate cuts. But then more importantly, again, how are people going to interpret? A lot of people are already in panic mode with the coronavirus, and what kind of message is it going to send with the Fed coming in at this point and pretty much using up most of their dry powder at this point in time, when we just had a long overdue correction. That's what I you've seen the coronavirus as a long overdue correction that was clearly priced in the charts, building for a long time with divergences and overbought conditions on the daily time frame and weekly time frames. And so the $1 million question, is it over, and will the Fed, save the day and bring this market to new highs, or are we going to see this market turn around and start to sell off? So let's watch the levels. Let's look at the levels to watch. As of now, this was the that first target on SPY on the 60-minute chart I'm on right now, 309.57 to about 310.65. We hit that level effectively yesterday, and we've been trading at it all day today. We popped again the initial surge from the rate cut, and we faded right back down. You can see the body of this candle right back down to the bottom of that resistance zone. So I still maintain if we can pop it with conviction, and you might say, Randy, that's no more conviction than that move. That doesn't count. That's an instantaneous pop on a news-induced thing that the algos they click in, and there's an imbalance of buy and sell orders. Stops get hit real quick. You have more buy orders than sell orders. The high-frequency trading programs, they run the market right up. They jump in front of your trades and my trades. That's why, Scott Trade, Ameritrade now, Fidel, that's why they're all going to free commission. They're selling your data, your order flow to the high-frequency trading platforms, companies, and they're jumping in front of it. And you can look that up. Interactive brokers, last I checked, claim they don't do it, but then they went to a reduced business model too, and I don't know, maybe they do now, maybe at least for that if you're with their low or zero commission thing. All right, enough on that sidebar stuff. Facts are, here's your trend line right here. I have it a little bit better drawn on the futures. I put it out this morning. For some reason it's not drawing there for me. There we go. Add a trend line. It's not as clear here on SPY, but I have it on the futures. We'll get to that in a second. So there's a trend line to watch. And more importantly, like I always say, resistance is resistance unless proven otherwise. So we're there again. The fact they popped it and couldn't build on it today, the day is still young, but that's a little bit concerning. So let's just see what happens. If we can print a solid 60-minute close above there, especially if we take out today's highs, I think the market will easily come up to these next targets right here, potential targets, resistance levels around 317.77 to 320.50. That's on SPY. And then you have the big old gap above there. So my targets on SPY were a little bit lower than the comparable targets on QQQ. There's the gap on SPY. And here, I'll give you another level now just in case the market loves what the Fed did today. You have that bottom of the gap, give or take around here, 325.50 or so. All right, and then the top of the gap too. So if you want to really look ahead, to me right now I'm in first things first mode. I don't like what I see, so I had swing trades in TQQQ and a lot of long-term accounts. My active trading account, I've been in and out short, but my swing trading account I'm still was holding out for those targets. And then what I did is I sold right after that. I sold some of those QQQ and TQQQ positions, which were short-term bounce trades that I was going to let ride. That was my initial plan, and I still am on some. I've taken some profits because I don't like what I saw today, and I'll set some profits, some stops, below the recent lows here, and allow that, the remainder of those positions, see if we can get up there to that potential third target, and possibly the next target would be backfill or back test of the trend line and that backfill of the gap around 229 or so. I'll turn that level on for you so you can see it a little better. So there it is. These are your overhead resistance levels. If you are bullish and long looking for more upside, you have the potential third target there, about 224.45 unadjusted. That's the actual resistance level. 229 or so, the bottom of the big old gap right there, and then the trend line there, back test. Should we turn down, then the same levels that were resistance on the way up should act as support. If they don't, if we get much more than this, I think there's a good chance this market could have a big washout move, take out the recent lows and take out that trend line. So if nothing else, be flexible. Don't be married to any one thing. The market must do this or must do that. Watch these levels. Let me get down to the 60-minute chart for you. 217.34 was a level that pretty much coincided with that that second target zone on the NQ, the Nasdaq 100 futures. We almost hit that, came very close to it yesterday at the close, and all night, overnight, you don't see it here, we traded on that level. And so far, like I said, little pop with the Qs on the rate cut announcement, but so far they faded most of the pop. We're still up. We're positive. This is the market trying to figure out what to do here, where to go next. All right, some reason I had an auto trendline draw feature that's no longer working, so we'll have to get back to that. So there's a potential trend line right there. Yeah, it doesn't show as well here on QQQ, so let me flip over to NQ. I like to watch this one. All right, NQ, here's my 60-minute chart, same one I've been sharing recently. Posted this in the trading room today, and then again on the front page this morning. You have this T2 zone. It runs from 88.90 up to 89.46, and the NQ has just been having a hell of a time getting through there. We hit that yesterday, right around the close, and that ramp into the close. I mentioned that. The bottom of the zone was hit all night. After hours session, all evening, all night, we traded there. We traded there this morning. I was and still am targeting a pullback to at least this level, this former T1 level, about 8,700, and the uptrend line. You can see that uptrend line comes in pretty clean here on NQ. And the fact that they both come in together makes me think there's a good chance that that's going to be hit. Now, what do we have here? Besides that, if you take that uptrend line, and I'll draw that again, and you take this, as I pointed out this morning, we had this form last night. We put in a divergent high. The indicators down here, the RSI up above and the PPO down here, put in lower highs with the with NQ prices putting in higher highs. That pop today only extended that. So now you have the makings of a bearish rising wedge pattern right now. I've had a couple questions at least in the trading room. Randy, are these bear flag patterns? And my answer was no, but effectively this would be the same net effect if we reverse here, and NQ makes a solid break down below that level. If we happen to reverse, we haven't even done that yet, or at least we've reversed several times, don't get me wrong, off there, we almost hit it. But if we break that, you're going to break trend line and you're going to break horizontal support. So it would have the effect of most likely causing an additional thrust down. And then again, it works in reverse. What was resistance before, about 84.90, should act as support. If that goes, that's bad. And if that goes, I think we'd just waterfall at that point. I don't think we'd zigzag down. If we get even close to the lows, we'll probably see panic selling step in and maybe get another flush out move. So that's the bearish scenario. These divergences are not confirmed and need to see the PPO turn back down again. And it's all right here. Basically, right now, as I'm doing this analysis, it's where we left off yesterday. We rallied up, hit the first target zone where I expected a reaction, and we got a reaction, and then some. That's in the form of both a pullback and a consolidation. But let me show you something here. So the market, the way it works is this. So you have this period of consolidation now over the last couple days in that area. And here was a comparable period of consolidation. Now this was in a downtrend. And this could have broke either way, but it didn't. It didn't break to the upside, it broke to the downside. And that set the tone for the next move, the next major leg down. Had we gone up there, that would have been bullish, and then you'd have support where this resistance level was. If we came and back tested, that would be support. That would be an objective long. However, it worked in reverse. We broke to the downside, and then support, once broken, becomes resistance. So you can see we came up, made a perfect back test, and this consolidation period was just a consolidation within this larger downtrend into the lows. We are now in an uptrend. So, as much as I am suspicious of this pop on the rate cut and suspect that we could see some pretty ugly selling if the market decides they don't like it, they don't like what the Fed did, or for the reasons they might have done it, then this uptrend could be in jeopardy. Right now it's still intact. There's your trend line, and we'll keep it very simple. Why, to loop back, why is that not a bear flag in my opinion? It's just too big. The question that was asked was this right here. Was this your bear flag pattern? And no, you do have what looks to be, a flagpole or an impulsive move down, absolutely, followed by a period of consolidation that takes an upward form. But this is a little bit too long in the tooth. It's not. It's not symmetrical. What's the term? Proportional. It's not proportional to the flagpole. When you have a flagpole, you want to see a flag that's relatively small. If your flagpole looks like this, the initial move down, your bear flag pattern should look something along these lines, and then you continue down. You don't want to see this, very large, oversized flag relative to the flagpole. So that's that. And then again, but we can watch that uptrend line and recognize this for what it is. So this is not an all-in short moment. The market may end up not liking what happened today, and if so, watch those levels. You get the sell signals. You can certainly short here. I already showed you we're at resistance. We continue to fail at resistance. There was a little stop clearing pop right there, but you can go back in. But you really want to see QQQ, I'll tell you at this point. Fall back below that. Let's see. Let's put on a 1-minute chart. And this is active trading stuff, I know, but there it is. See that level that's capped right about here, 216.50, call it, maybe up to about 217.50. I'll add a second line there, and we're starting to move higher. So that's good. We're putting this level of consolidation behind us. So if the market can build on this and really take out today's high after we spiked, that's the spike right after the announcement there, that should open the door for a move up to the next targets. That's how it works. And we would have taken that resistance level out. Everybody says they're okay with this 50 basis point rate cut, more juice for the market. And then targets would be, well, you saw some on the 60-minute chart, but I'd say head on up there and test the bottom of that big old gap from Monday, February 24th. Test the bottom of that gap. And gaps, once entered from below, are usually backfilled. So then the next target in that case would be about 229 and a back test of the trend line. What would that mean for you? That's about up there. We're talking about another almost 3% and almost about 5% to the top there. And that's pretty much it. Let me wrap it up here. Let me not go round and round. I showed you the levels to watch, and trade it. Like I said, be flexible or stay out if you don't know what to do. If you're already in a long position from the other day, great. It's moving up right now. The trend is not in jeopardy as of now. We made a higher high today, so this, an uptrend is simply defined as a security making a series of higher lows and higher highs, and that's what we have right now. So you can continue to trade that trend, but the trend is your friend, I should say. Continue to trade the trend, but watch those support levels below. My guess, we're probably going to go down here. Another thing that I factor in is the 60-minute PPO. The signal line, I use that as a trend indicator because it's the last of the two to cross, that white dotted line. It's the slower line. And it does a great job of defining bullish and bearish trends. You can see here as I zoom back out on a 60-minute chart, we were below trend here. That was a correction back then. There was a bear flag. Roll back a little. You can see we had, it doesn't look like much on this scaling because you had such a huge drop, but that was a tradable drop of about, 4%, 3%. And you can see since then, plain and simple, here's the zero line, this dashed line here, when the PPO signal line, again, that white line I use because it's the last of the two to cross, so you don't have as many whipsaw signals. Bullish trend, and it crossed there, and it told you the trend was bearish this whole time, and it was. We gapped down, we went down, had a little correction, and then we popped back up out of that trading range, and it said bullish, be long, or the trend is bullish, and then boom, it flipped here, and right now it's still solidly in bearish territory. So that's one consideration among many right now. SPY, same story. There's that 60-minute PPO. Also has done a great job of telling you, the intermediate term trend, at least a trend on this 60-minute time frame, and it actually works well on the daily too. You go to a daily chart, and you'll see that tends to work this also as a pretty good trend indicator. And so here we are on SPY. daily chart, and you can see that is solidly down below the zero line. Had a little whipsaw there, but it was bearish there, and it told you that's a good time you would have been either short or out of the market. And right there, correction mode. Other than that, for the last several years, it said the trend was bullish. Of course, it did a great job back. Remember that meltdown in 2018 right there? Look, told you the trend has changed somewhere in there, and it told you it didn't go back to bullish to right there. So although it doesn't catch tops and bottoms, it told you at this point in time, early on, when we had these sharp kickback rallies, which were comparable, by the way, the one we just had. I remember those were about 10% right there, those two. And it told you at the time, hey, the primary trend right now is bearish, and then they proved to be just counter trend bounces. So there it is, guys. Mixed bag. QQQ or SPY taking back the 200-day moving average, but again, QQQ successfully defended it the other day and is well above it. So I'm going to wrap it up here, get this out to you guys, and we'll let the dust settle. I think this market will most likely pick a direction by the end of today, maybe no later than tomorrow, where everybody's had a chance to digest what does this mean. Is it a big deal? The Fed cut this, rates 50 basis points. Is there something that we should be worried about, or hey, is that just more juice for the next leg up? Embrace it and be long. Possibly, we'll see. Hopefully, we'll know in the next day or so here. All right, we'll wrap it up here. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.